What's up everyone, it's Scotty with MoneyVest, and in this video I wanted to talk a little bit about oil prices and more specifically employment as well. I was doing a lot of research because I wanted to understand how significant of an impact energy prices and oil is going to have on overall inflation. I was actually surprised to learn what I learned during my research, which I will share in this video, and I will back that up with the research that I was looking at. So, hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like, and of course subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, and trade ideas, and members only private videos, and of course our intrinsic value spreadsheets. Again, there is a few more spots that have opened up, and there is a 16% annual discount that we are restarting till the end of this month. So links are going to be down below if you're interested in joining. Now, answer me this question. Before we get further into the video, do you believe that the oil prices going higher is going to have a higher or a lower impact on overall inflation? Once again, I repeat the question. Pause this video and answer right now in the comments. Do you believe that higher oil prices, the increase in oil prices that we have seen in the last 3 months, is going to have a higher or a lower impact on inflation? Comment down below, and I want to see what everyone says before this video is over. So let's just dive right into it. So this right here, what might oil back above $90 mean for inflation? Okay, so this was a report published by Schroders, and they basically published this research report, and I also looked at another resource, and the findings and the conclusion was very similar. So, will the increase in energy costs be largely absorbed by businesses? So, alongside numerous unplanned refinery outages and, of course, production cuts from Saudi Arabia and Russia and OPEC Plus countries, this has caused gasoline prices to spike just as the summer driving season moved up in top gear. In August alone, pump prices rose some 30 cents to $3.80 per gallon, and I think some states are even as much as $4 and $4.20 per gallon. And after accounting for these seasonal effects, the contribution of gasoline price ought to shift from -1 to 0.1% to the annual CPI inflation in August. And in isolation, this should push the headline CPI rate back above 4%. So what they're really asking is that, will oil prices back on the rise, and with the increase in energy prices, is history set to repeat itself? Because you can see that we have seen US CPI move very similar to US energy CPI, right? So this is the green line, which is the energy CPI, and the blue one is the headline CPI, and they kind of move in tandem with each other. Of course, energy is a little bit more volatile. You can see that over here, it's had a much bigger swing compared to the overall headline CPI. But of course, in the 1970s and 1980s, headline CPI was far more aggressive than the energy CPI. So obviously that blue line is above the green line. But for the majority of this last 20 years or so, we witnessed energy to be more volatile than the headline CPI. And this right here, of course, is the inflation rate kind of from 2023 to 2013 to present versus March 1966 to 1982. And what you'll notice is they're almost identical. And the yellow line obviously is 1970s, 1980s, when we got that double top inflation and that double dip recession during that time. And again, the question is history going to repeat itself? Meaning that, are we going to see inflation for the US in 2023 once again spike back up like it did back in the 1980s? And we are going to see that double top in inflation on the back of these rising energy prices, right? That's the real question. Now, to my surprise, energy prices and oil prices, they don't affect inflation as much. Although I do disagree, because yes, on theory and based on data and based on statistics, it may seem like energy prices don't play a big role, but in reality, we know that it does. Okay? So, but what do higher oil prices mean for core CPI? Here's the important takeaway. While energy is not directly included, because we know core inflation excludes for food and energy, oil is an important intermediate input for goods and services. Consider the ubiquity of plastic, for instance, which uses 90% of fossil-based sources, right? In creation of plastic, 90% is created from fossil-based sources. And as such, there will be some knock-on impact from rising oil prices to core inflation. And with core goods and services accounting for roughly 80% of the CPI basket, it is important to quantify what impact is likely to be. Now, Goldman Sachs put together a commodity content list for core CPI, which I'm going to go over in just a minute. And their analysis suggests that energy costs make up as much as 15.9% of some categories. In aggregate, this accounts for less than 2% of overall core CPI. Why so low? Partly because rents comprise such a large share of the price basket, but even excluding for these makes little difference. It is mainly due to the price charged by producers being diluted by wholesale and retail margins, which can often account for half or more of the prices paid by consumers. So meaning that since shelter and rents make up majority of core inflation, energy prices and the increase in energy prices only accounts for less than 2% of overall CPI. So this is the report from Goldman Sachs, which Schroders basically cited, and they mentioned that energy, of course, in the energy CPI is over 27, almost 28%. In other, makes up 0.3%. In total, makes up 21.1%. But in core, as you can see over here, core 1.1%. And of course, energy's weight. Actually, this is the column that we need to be focusing on. This right here is energy. So in core, and if you go core and energy, 1.7% contribution, right? Commodity content of final CPI value. All items, it makes up over 3.7%, and core, it makes about 1.7%, which obviously is really, really low. And majority of that's coming from public transport, which they cited 15.9%. And everything else, like recreation, 1.5%. Education, only 3.7%. Auto parts, 1.3%. Medical goods, only 1.3%. Tobacco, only 1.5%. And again, I don't it's hard to think about that, right? I mean, theoretically, you think that these things are going to be affected more by energy because most things are created with the use of energy in some way or another, right? Fossil fuels and oil-based and whatnot. But I'm kind of surprised to see that most things are less than 2% contribution of energy in those commodity items. Only public transport, obviously, which makes sense, is almost 16%. But everything else is under 2%. Even alcoholic beverages are at under 2% of energy use. And this right here is basically showing us the percentage of energy passed through to core CPI over 24 months, which can be anywhere between 40 to 50%, meaning that half of this is being passed over from the producers over to the consumers. So they mentioned that Goldman Sachs estimates that firms passed through 45% of rises before the pandemic, but this climbs to 60% when including data over the past 3 years, meaning that firms or companies and producers pass through 60% of that cost over to the consumers. They ascribe the pickup in the pass-through rate to lower competitive pressures amidst demand-supply imbalances and less willingness to absorb oil price increases due to broad-based cost pressures. And putting this all together, we can assume that roughly half of the 20% rise in oil prices over the past 3 months, but right now it's been 40%, so 40% increase since May, half of that is 20% will be passed on to consumers. And since energy prices account for 1.7% of core CPI, this suggests the total inflationary impact will be less than 0.2 percentage points. Given that this will spread across several months, it should be barely perceptible. So this number is actually going to be a little bit higher at closer to 0.3 to 0.4% because they're pricing in for 20% increase in rise in oil prices. But we know that since May, prices are up close to 40%. So we can more or less double this number right here. So it's going to be 0.4 percentage point impact on core inflation, which is still a sizable impact because 0.4% annualized is roughly under 5%. Now, they also go on by saying that even the impact on headline inflation ought to be more muted than it has been in the past. So not only is core inflation going to be muted, even headline inflation is going to be muted with respect to the rise in energy prices. And that is because energy intensity of the economy, which is calculated by total energy consumption divided by GDP, has fallen sharply over the past decades. And that is to say that the British thermal units, which basically takes into account the energy intensity, has fallen by 16 BTUs to now sitting at just a little bit over 5. That is a 60% decline from 1979 energy crisis. So we're not using the energy as much, right? The energy intensity has dropped. So consumption divided by GDP has fallen significantly. And this right here was another report that was posted on another source here, which basically mentioned the response of inflation to a one-time gasoline price shock. Of course, headline CPI has a much bigger shock because it's included in the headline CPI. Core inflation, since it's excluded, indirectly, it has a much smaller impact. So they mentioned the dark line is the response estimate. The shaded area captures the uncertainty about this estimate based on a 68% joint credible region. And when you look at the cumulative effects of gasoline price shocks on inflation, this conclusion came out to basically suggesting that the figure 2, which is over here, confirms that this impact has been modest at best and at times negligible. For example, in May 2022, gasoline price shocks cumulatively added 1.2 percentage points to a 12-month headline CPI compared to the actual rate of 8.5%. So what they're saying is, in May 2022 or June 2022, when inflation was at 8.5%, only 1.2 percentage points of that came from actual increase in energy prices. The corresponding impact on core inflation can be safely ignored because it was not even meaningful. Concluding remarks, our evidence suggests that unexpected increase in the level of energy prices by itself does not create persistent inflation. It only creates a blip in the inflation rate. In other words, inflationary pressures in monthly data wane as soon as positive gasoline price shocks ease, and when gas prices stop rising, headline CPI stops growing and starts declining slowly. But of course, we are on the way up, so there is going to be some modest impact on overall inflation, but just not as much or not to the same degree as what we expected or what we have witnessed in the past. So this right here, finally, is what is going to play an impact in overall inflation. It's not energy, according to Schroeder's and the other report that I just cited, but it is going to be employment. And this is something that we have also talked about in our previous videos because we know that wage gains have been significantly higher right now. So wages have been growing at a much faster rate than anything else. Not to mention that average hourly earnings are up, and the unemployment, the JOLTS number, the job openings to unemployed persons ratio, has also been declining. So there is a significant imbalance right now with the excess number of jobs with respect to the supply of labor. So there is the imbalance there. And as a result, wages are very much at a higher level. So excess demand for workers is keeping wage growth elevated. And they also mentioned that Atlanta Fed wage tracker has rolled over. It suggests that pay is still growing at over 5% per year. But as we highlight in our recent updated forecast, ultimately it is not wages, but unit labor costs adjusted for productivity, which matters for both companies and inflation. So they go on by further saying that ensuring that this is sustained is the central to the soft landing narrative playing out. The recent rise in business investment is certainly encouraging on this front, but CapEx does not always translate to productivity gains. And AI, of course, could, in theory, have multiple use cases, but it does take time to deploy, widely across the economy. And so any material boost in productivity seems some way off. So while we expect U.S. core CPI inflation to ease to 2.6% is what they're suggesting by the end of next year, there is a risk that it could prove to be more sticky, but it will be at the expense of labor market, not oil prices, which will determine whether that is the case. So this report and a couple of the ones that I cited basically are suggesting that it's really going to be the labor market that dictates where inflation goes and not the oil prices, not the energy prices, which, on theory, and again, based on statistics and data, makes sense. It does tell you the data. It does back it up with actual data, but I just don't find it to be true because at the end of the day, energy prices are really what dictates everything that we do, right? Everything that's coming to us, everything that's transported to and from us, everything that's used in creation of goods and services uses some level of energy. And of course, 1.7, 1.5% seems a little bit on the lower end, but I guess that's really what it is. And I can't argue with the data and the logic and the numbers. So apparently, it's only going to be 0.2 to 0.4% impact on core inflation, which in my opinion, I think is still pretty pretty reasonable impact because annualized that's over 2.4 to as much as 5%. Of course, if oil prices continue to go higher and they are persistently more elevated, then that impact is going to only increase, but it's not as much as what we expected in the past. So let me know your thoughts down in the comment section below. What do you think? And I want to know from your earlier answer as well. Did you guess it right or wrong? Let me know in the comment section down below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.